Hey guys, Steven here, aka the Boiler Master. It's Sunday morning, so you know I'm having my coffee and doing DD. There's a couple things I love is coffee, DD, and charts. I have been able to update quite a few since IQST gave us an update on Friday, and I figure I'm just going to go ahead and go through that update, share some of my charts, and then I want to talk a little bit about valuations. One of the main things I keep seeing asked on message boards is that we know IQST is undervalued, but what's it actually worth? So I've put together some charts there, some future projections, and see if we can come up with something reasonable. I had to come back and add that this video is quite a bit longer than I expected. I had a surprise caller towards the end, and well, we had a lot of good things to talk about, so stick around and see what we had to say. So here's the PR from Friday, short and sweet, straight to the point, which is what we've been asking them to do. No fluff and buzzwords and promised timelines, just straight facts. And that's exactly what they gave us. Title of this article was actually IQST Shatters Revenue Forecast, which is what they did. It says 120 million 2023 revenue forecast. They came in with preliminary revenue of 140 million. It also says that Q4 improved on gross margins, which is good because Q3 was profitable. So I'm looking forward to seeing the annual filing, the 10K that we will get on April 15th or about there. So here's a chart I've got that shows basically their history. They always underpromise and overdeliver on revenue. You can see this year, 2023, they started off with an initial forecast of only 105 million. It was around late spring, early summer, maybe May, April, that they upped the revenue forecast from 105 to 120 million. Naturally, they came in at 140 million. We knew they were going to destroy this, but I wasn't expecting a full 140 million. What's that look like year over year? It's 50% for year 2020-23. So 2021 was 44%, 2022 was 44% growth, and 2023 beat that at 50% growth, which is just amazing. After they crossed the $100 million mark, I did not expect them to continue growing at this rate. I thought it would taper off a little bit. The bigger you get, the harder it is to maintain those numbers. And from everything we can see, it looks like growth is accelerating. So what's that do for revenue per share? Well, we can see they finished the year at 140 million revenue with 171.5 million shares, so that brought them up to 82 cents a share. Last year they were at 58 cents a share. So 2021 hit 44 cents for a 15% increase. 2022 was 58 cents for a 31% increase, and 2023 was 82 cents a share for a 42% increase. That's pretty damn good. Like I said, I wanted to put together some future projections, analyze these trends and see where they're going, where they might go. Want to take a look at the previous quarters and see what this track record actually looks like and how sustainable it is. So I've put together 12 quarters for us. That's 3 years worth of quarterly revenue. And you can see that it is consistent. They are accelerating growth. There's no signs of slowing down at all. So we put 2023 down as 50% growth. I still think at some point things are going to slow down. They're not there yet, but they are working on a couple of acquisitions. I would like to see them close one because a lot of their growth comes from cross-selling. There were no acquisitions in 2023, but they did have two in 2022 in the summer. Those two acquisitions are responsible for a lot of the growth in 2023. They say that most of it's coming from cross-selling. So I'd really like to see another acquisition so they have those cross-selling abilities to ramp up and continue this growth in 2024 and 25. I'm sure they'll do it. It's just a question of when. If they close one now, they'll be cross-selling all year. If it delays and they don't do it until the summer, it's not going to be as impactful. So personally, I feel a little more comfortable putting them down at the 44% mark. They did that 2 years in a row. It's a good solid number. It's 6% less than they did in 2023, but it's still $61 million this year. So some people might think that's ambitious. I think it's fairly conservative, and I like to stay conservative so I can be pleasantly surprised instead of disappointed. So if we put them down at 44% for this year, that'll put them at 201.6 million in revenue. Another 44% in 2025 puts them at 290 million revenue. So we've got some revenue projections, but as you guys can see that a 40 or 50% increase in revenue doesn't actually equal a 40, 50% increase in revenue per share. That's because outstanding shares increases with dilution. So if we look at dilution and where that's heading, we can see it's been declining the last few years. 2021 saw 25% dilution. 2022 was 10% dilution. 2023 was only 6% dilution. And now that they've shown a profit in Q3 and say that they have improved on gross margins in Q4, we have to assume that they're operating at least at break even and won't be relying on dilution going forward. So 2024 and 2025 should see even less dilution. Now, they could dilute as part of a deal in an acquisition. The last two acquisitions they made, they did pay for part of them with shares. So we could see a little bit of dilution there. But without needing dilution to sustain operations, it should continue to decline. So I feel comfortable just putting them in at 5% dilution the next 2 years. That's a nice, safe place to put it. So that we're accounting for some. And like I said, we can be pleasantly surprised instead of disappointed. So if we forecast 2024 at 44% growth and 5% dilution, you'll see that revenue surpasses outstanding shares next year. In fact, it'll bring revenue per share up to $1.12. Same performance in 2025 would bring revenue per share up to $1.54. So what's that mean for valuations? Well, revenue per share is another way of saying a price to sales ratio of 1. If you have 171 million revenue and 171 million shares, well, a price to sales ratio of 1 would be a share price of $1, same as revenue per share is $1. But is a price to sales ratio of 1 fair, or is 2 fair? What do we look at? How do we know? If you want to look up industry averages on price sales ratios, first thing you got to do is decide what industry to look at. IQST, we know the majority of their revenue comes from telecom. They do have some revenue outside of telecom. IoT Labs, for example, has their smart tank devices that have brought some revenue. The entire subsidiary is actually described as a technology subsidiary, but they have told us the majority of the revenue still does come from telecom. So if you look at telecom sector averages online, it gets complicated because even that gets broken down further. You've got telecom services, telecom equipment. IQST is primarily wholesale telecom, meaning they deal with the services side of it. They provide services for companies like Verizon, T-Mobile, who actually deal with the end user retail consumer. So I've found estimates online saying the industry average is a 1.46, 1.48. One of them says 3.2. What I think applies closest to what IQST is doing is about a 1.5 price to sales ratio for the industry average. Now, the industry average growth for the last year was only 9.9% though, and IQST did 5 times that last year. So IQST is definitely below the average on earnings, meaning their profit margins. However, they're 5 times the average on growth. So if the average company is a 1.5 price to sales ratio and IQST is a bit behind on profits, but they're 5 times that on growth, we could argue all day long on what's fair value for them. So I want to run a couple scenarios on what these price to sales ratios might look like, what the share price could do with our forecast for 2024 and 2025. So looking at our projections, if we want to start on the low end of it, a 1.0 price to sales ratio, if we're happy with the 44% growth over the next 2 years and 5% dilution, then we're looking at a price sales ratio being equal to revenue per share. 2024 projecting out as $1.12 being a fair share price, $1.54 being a fair share price for 2025. But like I said, I think 1.5 is more realistic for today with what the company is currently doing. That would put 2024 fair value at $1.69, 2025 fair value at $2.32. If you want to go a little bit more aggressive with it and say that their 50% year-over-year growth justifies quite a bit higher price to sales ratio than the industry average, we can start looking at a price sales ratio of just 2.0. That puts 2024 at 225 fair value and 2025 at 309 fair value. You want to get really aggressive with it and say, you know what, over the next 2 years, I think they're going to be doing sales outside of telecom. They're going to have more from their technology divisions. They might have some EV sales. They're going to be more of a true holdings company then. We can start looking at maybe a 3.0 price to sales ratio. That would put them at fair value in 2024 at $3.38 and 2025 at $4.64. The company's traded higher valuations than that before. 2021, we know it had a blow off top. The stock ran just over $2. It did come back down. We all know that, but that was a 5 times sales valuation. If we plug in a 5.0 price to sales ratio, as you can see, 2021, it would have been at 219 a share, which is just about what it ran to. 2024, if it ran that high, we'd be looking at 564 a share. In 2025, we'd be looking at 773 a share. Now, 2021 was clearly overvalued. It was not anywhere near being worth $2 a share, especially when their revenue per share was only, 44 cents a share. They were trading at 5 times sales. They were not worth it back then, but that's not to say they're not going to be worth a valuation like that in the next couple of years. The key to these higher valuations is bringing revenue in outside of telecom, because telecom just has a lower average valuations. There's just not a lot of excitement and building in future speculation and potential, because it's a pretty mature industry and growth is pretty stagnant. So while those other companies are doing 7 to 10% on average, that's what brings down the average valuations. But when you get a company like IQST doing 40 to 50% growth year after year after year, that's where that speculation comes in, and they should go well above the average valuations. So like I said, I want to put about a 1.5 as fair value right now today. When we start seeing some more profit from the company, confirming there's not going to be any more relying on dilutions, and they start bringing some revenue outside of telecom, we can clearly adjust that up. But that's where I feel pretty comfortable putting fair value today, which puts us coming out of 2023 at $1.22 a share. So 1.5 price to sales ratio. There's not a lot of speculation built into that. But you look 2 years ahead, and fair value would be 232. The returns investing at $1.22 to 232 are insane. So it makes today worth more than that as well. If you know it's going to be worth 232 2 years from now, pretty good buy at $1.80, $1.70. But here we are sitting at a 16-cent share price. So what's going on with that? It's like it's too good to be true. Well, it kind of is, but if you zoom out and look at why the share price is down, it really makes perfect sense. You look at the stock chart from 2021 until present, you can see that pump to $2. It ran from like 8 cents to $2 in about a 6-week period. It was insane. Everyone knew it was just pumping and it was going to crash back down, and it did. However, it took about a year to do that. It was mid-2022 when the price had finally settled out in the 50-cent range, and that was somewhat fair value at the time, coming out of 2021 with the revenue and margins they had at the time. But that's also right as the market started to shift and money came out of risk assets. So right as the market started to sell off risk assets, they also entered into their options agreement with a funding group to raise some capital. They wanted to raise about $4.8 million. The problem was that it was structured in a way that they could raise that regardless of share price. So if the share price went down, they could still raise about the same cash, but it would issue more shares. Share price went up, they could raise the same cash, but issue less shares. Well, as the market shifted and risk assets sold off, the price plummeted. It meant that more shares could be issued for the same amount of money, increasing the amount of dilution. In fact, if you look at the charts on that, it was a max pain, worst case scenario of 48 million shares being issued, and that freaked everyone out. So naturally, a lot of investors failed, but on top of that, they started issuing the shares, raising the cash. The company that was buying the shares was getting them at a discount and just immediately offloading them, dumping on the market. That agreement was in place for 12 months. It did expire. I believe it was September 30th of 2022 until September 30th of 2023. So it's done now, but it was a full 12 months and counting of issuing shares to raise capital, and those shares just continually being dumped on the market, and it went on throughout all of 2023. In fact, the running joke with me and some friends was, if there's no selling, there's no volume. The longs just stopped buying the ask altogether. We know if we just put our buy orders in below current price, sooner or later they would dump and fill those orders. So it was nothing but downward pressure for just about all of 2023. Those of us that have followed that closely, obviously the dilution was not nearly as bad as it could have been. Dilution for 2023 was only 6%. It really wasn't that bad. But throughout the end of 2022 and 2023, it was close to about 20 million shares that were bought and sold on the market. And with a low volume stock like this, the average volume is only about 380,000 shares a day. It takes months and months and months to move that kind of share. So that's where I see the main reason the share price is down. We were a prolonged correction from an overdue pump and dump, entering a recession, risk assets selling off, and then that domino affected with the dilution deal that they had made that took an entire year for that to expire and several months longer for them to offload the rest of their shares. So far for 2024, we've only had a week of trading, but I have seen complete 180 from the stock. Instead of all selling pressure, major orders just dumping and dumping. Anytime a buy order would come in for 100,000 shares, somebody would dump and fill that order. I haven't seen that at all this year. Tuesday, when the markets open, it was like 80-90% buying pressure, over 400,000 shares traded, pushing the price up. Wednesday and Thursday were a bit low, mostly buying pressure, but very low volume. And then Friday, volume picked up again, and a vast majority of it was buying pressure again. That's the first time in probably 18 months I've seen a week straight where nobody was dumping by the hundreds of thousands on the market. So a lot of us believe they are out of shares. The options agreement did expire. So there's not been any dilution in around 2 months now. In fact, I got to give a holler out to our friend Shane Crawford for updating us every Monday. Every Monday, the outstanding shares is updated by the company. Shane keeps an eye on that. He gives us a post every Monday to let us know if it's changed. And I haven't seen it change from 171.5 million in probably 2 months now. In fact, why don't I just give Shane a call? Let's get his input on some of this. All right, let's see if I can get Shane on the phone.
Hey, Steven, what's going on?
Hey Shane, how you doing, man?
Doing good. How about yourself?
I'm all right. I'm making that video we were talking about. I was just explaining how you update us on the outstanding shares every week. I thought you might want to give some input on the dilution. You've seen some of the charts and you watch it pretty close yourself. Where do you think we're heading?
Oh, yeah. Okay, so we're 171.5 right now.
Yep.
And there was what, 9.9 million, just about 10 million for 2023.
Yep, just
right?
under. Yep, it was, I believe, 6.15% dilution last year.
Okay, so 6.51% dilution for what, 50.2% growth?
Yeah, 50.2%.
All right. You happen to have the number handy for what 2022 was?
I do. Let me pull that chart up. And I have shared that for the audience as well. I'll bring it up again.
Okay.
Well, 2022 was 10% dilution.
Holy cow.
Yeah, a whole lot of shares there. The actual share amount on that, if you'll bear with me just a second.
Oh, yeah.
It was 2022, they added 14,148,000 shares, and that was 9.6% dilution.
Okay, so we went 14.1 to just under 10 million.
Mm-hmm.
And the revenue growth has continued to grow each year. Dilution has come down. If you were to draw a line through it, I feel like it stands to reason you're probably going to do somewhere between 5 and 8 million shares added for 2024. Now, of course, we're ballparking it, but my thing is if that comes down and then you maintain 40 to 50% growth again, I don't quite follow how people could really complain, because growth is outweighing dilution by such a major amount. It's like if you're trying to reach $1 billion company, this is the way that you would want to do it.
I absolutely agree with you there, Shane. I see on the message boards all the time the bears just scream dilution, dilution, dilution. But, 6%, 9%, what's that mean when you're growing over 50% a year or 44% a year? And I went ahead and brought up my calculator here. You're saying 5 to 8 million shares, maybe. 5 million shares this year, 2024, would only be 2.9% dilution. I've projected it out. I went 5% dilution just to play it safe. I like to be conservative. 5% dilution would be 8.5 million. So you think 5% projecting out the next 2 years is conservative? You think would you go lower, or you think 5% being 8 million is pretty reasonable?
Here's the thing. I think you're pretty much right on the target. And greatness recognizes greatness. So you did. So with that said, in fairness, I think 5% is actually probably too much. Like I don't think they're going to do that much, just because when you begin to incorporate in profitability, that's going to offset a little bit of that dilution that they've had in the past. Now again, if there is a large acquisition that they're looking at that could add a substantial amount of revenue, profit, and also continued growth year over year over year, then maybe we could be looking at 5% dilution for the year. And in my eyes, that would be completely worth it. If you buy a company that can add 50 million revenue this year and continued growth the following years, again, to me, I still would not complain about that level of dilution, because I want something. I want a company that's being respectful to shareholders, but also growing at a rapid pace. And that meets the criteria to a T.
I couldn't agree more. I did talk a little bit about some dilution when it comes to acquisitions. Last year they bought Smart Biz and Whistle, and both of those they paid with a mix of cash and shares. They were 1.8 million each for the acquisition, and a little bit different on the ratios for each of them, but it was about half cash, half shares. So I'd have to look at the numbers. I've got it, but it is about 900,000 cash, 900,000 worth of shares for each acquisition. So very minimal and very value added. What I like to see from that is it means the guys that are selling the company, yes, they got some cash, but they took shares as well. And those shares have a lockup period of at least 12 months. So it shows that not only are they selling part of their company for cash, but they're selling it for a stake in IQST. And you don't do that unless you see IQST growing the business and adding value to those shares. So I would say that it's definitely okay to put a little bit of shares into acquisitions, but I'm not certain that's even going to be necessary, because right now they're working on a deal with LEA Capital. As you know, they said that they have preliminary negotiations, which I figure is just a starting point to start the conversation. Yeah, they said 5 million upfront bond for the purpose of acquisitions, and another 5 million bond after an uplist to Nasdaq. So that's $10 million available in the form of bond sales, with 5 of it being earmarked for an acquisition. So unless they spend more than 5 million on an acquisition, they may not even need to use any shares or raise any other additional capital from dilution.
Yeah, that's an absolutely great point. And I'm not sure if people are fully recognizing the benefit of that, because, okay, you combined this 5 million upfront from the bond, add that in with some profit, you may not have any share dilution moving forward. Like, there literally might not be any need for it. And I don't think we're getting ahead of ourselves when we draw those conclusions, because the numbers on it just line up. And you look at how responsible the company has been with cash over the last years. And again, I know everybody complains about dilution, but you look at the value they added with the minimal dilution, it's incredible. Like, it really is a wonderful job that they're doing. And, now that they have reached profit, and yeah, it was a little bit of a journey to get there. I get that. But the thing is nothing happens overnight. Like anybody that's had a business or ran a business or just understands the intricacies of a business, those things do take a little bit of time. They do not just happen overnight. So it's like when we zoom out and we kind of take ourselves out of the situation and we don't focus on the share price, because it's easy to do that. Like when you buy a stock, people often don't realize they're buying a piece of a company. So you get so emotionally involved. Like when the share price goes up, you think something great happened in the company. And when the share price goes down, you think it means it's going bankrupt all of a sudden. And that's, that's simply just not the case of how things work. Like stocks go up and down every day, and investors are fickle, and you never know why someone's going to sell, and you know why people buy because they think it's going up, but people sell for thousands of different reasons, and you can't ever figure that one out.
Yeah, I couldn't agree more. And it reminds me back to our point. We discussed this heavily towards the end of 2021 when we were going through the options agreement and the worst case scenarios. And man, I remember, I'm going to see if I can find it and pull it up. I even made a post and broke it all down because everybody was freaking out in worst case scenarios. And I calculated it out and said, look, based on the share price and how many could be issued, I estimated, I think, somewhere around 180 million shares being kind of a likely scenario. They came in the end of the year at 171.5. So I was an over on my estimate. But when I calculated out the increase in shares versus what they were likely to do in revenue, the revenue growth still heavily offset the increase in shares. And the best way to illustrate that, the reason I always do these revenue per share charts and stuff, is because you can see that even though they had that dilution, revenue per share still increased 42% last year. We went from 58 cents a share to 82 cents a share, and people are freaking out saying dilution's out of control. If dilution was out of control, shares were increasing faster than revenue. Revenue per share would go down. It wouldn't go up 42% year over year. So
yeah. Of course, this is one of those things where knowledge is kind of key to this battle, because people will get in these, you go into a stock room or this or that, and a couple people will kind of push this narrative and make everything very fearful, when in reality, I just don't think there's any legitimate possibility of them going bankrupt or anything like that. Like, I don't see it. And I know they say like nothing's ever safe, but it's like, man, I don't see it. And that the way that this stuff is growing, it's just incredible. And it's like, if somebody had the ability to sit back and hold this stock for like another 5 years, another 10 years, it looks like it's on a clear trajectory to be $1 billion company. And it's like, I'm not just pulling stuff, from the sky here. Like, we can see the numbers. Like, this year was 50% growth. The previous year, 44%. 2021, 44%. It's like, they should have slowed down this year, and instead they picked up steam.
Right? I couldn't believe it. I remember you and you and I were talking about this when we started seeing the Q3 numbers in the preliminary, and we just couldn't believe that they were on track to surpass last year's 44%. It was like, how are they accelerating growth now that they're into over $100 million? It's insanity. It really is.
Exactly. And to your original point, where do I think they're going now? Well, I've kind of been open that I truly believe they're going to do 200 million this year. Like, I think that's the amount that they're going to hit.
43%. That's it. If they do 43% this year, they hit 200 million revenue. So 2023, they hit 100 million. 2024, they should hit 200 million easy. The question is, can 2025 keep that pace and hit another 100 million milestone in 2025, doing 300 million? Because at that point, you want to do another 100 million the next year, it's only 33% growth. They're going to be on track to hit the 100 million milestones year after year after year until they hit to a point that they're $1 billion company.
Well, and let's add in why we think that is. It's incredibly likely there will be 2 acquisitions this year. Okay, that's going to add revenue up front, but it's also going to add growth the following years. Smart Biz and Whistle did the same exact things, and now we are reaping the rewards of that. It's gigantic.
Absolutely.
So if there's 2 acquisitions this year and then 1, let's say next year, maybe 2 next year, like, it's entirely possible. LDA Capital really loves the work that they're doing, and they negotiate for a different bond deal. And maybe I'm reaching here. I'm trying to look forward because things could get pretty big here. And I don't know that people entirely see the big picture. And I've said this before, I wish people could see what I see.
I agree with you 100%. And I want to touch back on the acquisitions because people, I can't tell you how many times I've seen a bear saying they're just buying growth, but you've seen my posts and I've broken down the DD and the numbers. They bought Whistle and SmartBiz with an anticipated, I think, 11.6 million in revenue a year is what those were expected to add. And we haven't seen Q4 filing yet, obviously, but as of Q3, projecting it out, they were going to do at least like 27 million in revenue this year, and that was if Q4 didn't even grow anymore. They did, I think it was 10.4 million in revenue in Q3 and alone, and we thought they were going to do 11.6 in an entire year.
It's wild, and we don't think that could happen next year also. Can't it grow next year too?
Exactly. That is where IQST just really stands out. Their cross-selling abilities between their telecom subsidiaries. Both acquisitions they're looking at right now, they have said, are telecom companies, and if they buy them, why would they not do the exact same thing they did with the last two, and in 12, 18 months' time, do 300, 400% the revenue they were doing before IQST owned them?
Exactly. They have a unique ability to buy these small companies, incorporate them into themselves, and then rapidly grow them. It's a fantastic thing. And that's why, that's why sometimes I almost think it's not a bad idea for them to stay as a telecom company, because it's like, it seems they are masters of doing that. Yeah. And I want to give credit where it's due, because they do a fantastic job at that.
They really do. They really do. See, my thing about it is a holdings company. They are trying to get into some new markets. I can definitely appreciate that. People are upset they haven't really succeeded yet, but I can appreciate that they're not giving up. They're continuing to try. And it's not because I want those sales today. Nothing they do today is going to come anywhere close to telecom. Telecom is going to dwarf it. But 10 years from now, eventually this company is going to plateau like the other big ones out there, the behemoths, and growth is going to slow to your industry averages. Maybe they come down to 20%, 10% year over year growth. By the time that happens, they do need to be in some other industries. So as telecom starts to taper off, these other industries can start picking up. And that's how they maintain. That's how, a decade or two from now, they're a blue chip company. That's how they're going to do it. I mean, not that they can't do it with telecom alone, but that's the true end goal that I see is a behemoth holdings company in multiple industries, well diversified, and they start seeing some of those valuations that are on the higher end some of the other industries have.
Absolutely.
I mean, I think you're like me. I'm looking forward to a Nasdaq uplisting when it happens. But beyond that, I have no intention of liquidating my entire position. I want to hold a good chunk of my shares indefinitely, because until we see a point that growth drops into the single digits, I just see no reason to sell all my shares. Why?
Yeah, to that point, it's everybody likes to think that the Nasdaq is like the end goal. But the way I see it is that's when it just begins. Like, that's when the fun just starts.
Absolutely.
Because if you're growing 50% every year, well, the share price is incredibly undervalued. So how long is it going to be until the share price gets that figured out? Well, certainly once it's on the Nasdaq, but you're going to start having institutional investors come in and want stake in that. So does this reach a point where it's overvalued as compared to undervalued? And I think that will absolutely happen at a certain point. But is it this year, next year? Is it farther down the road? But it's like you eventually continue to grow so much and so rapidly, you won't get ignored forever.
Well, and to your point, Nasdaq is just a start. What are we talking about right now? LDA, $5 million right now for an acquisition in the form of a bond sale, not dilution. Yeah, and if they uplist to Nasdaq, they're already talking about another $5 million in funding. And don't forget that a year or two ago, they had structured a deal with an investment bank to loan them $60 million for their acquisitions campaign if they can uplist. Is that still on the table? Are they going to have $60 million from a bank and $5 million plus from LDA? What's their merger and acquisition campaign going to look like once they're on the Nasdaq and they're lining up to loan them those kinds of funds for them to buy new acquisitions?
You hit the nail on the head. and that's why I come back to what I just said. People like to think the journey's over once they're on the Nasdaq. It just begins, because so much capital opens up to Nasdaq companies that is not available for smaller OTC companies. And sure, they're penny stock exempt and all that. You know, they have a lot of the green check marks. But at the same time, it's like when you are officially there, it's just a different playing field. That's just how it goes.
It is.
So tons of money will open up, and then the amount of things they can buy become limitless. Instead of buying, for example, 2 small telecoms in 1 year, Smart Biz and Whistle, they could be buying 4 a year, and that could continue for years. And that's the thing. It's like the potential is near limitless because of how effective they are with their cash.
Well, see, my thing isn't how many acquisitions they can make. It's how big are the acquisitions going to get. Yeah. You figure Smart Biz and Whistle were 1.8 million each. Well, they got 5 million sitting on the sideline with LVA. Right. They're negotiating right now. What are they going to add in revenue from a $5 million acquisition? What can they add in revenue if they get the funding and start buying companies for $50 million instead of $2 million? Yeah.
It'd be ridiculous, man.
It would be insanity. They might add $100 million in revenue from one damn acquisition.
Right. Yeah. Again, a single year, and that doesn't take all the other organic growth. So it's like these are the kind of things where instead of having like a 140 million year this year, the revenue could double coming into next year.
Easily.
You know, easily. And it's like that's the thing. People like to think that growth is going to slow down because they're getting bigger. I don't think so. I see it accelerating into that because all these new funds open up.
You have some good points there, Shane. But right now, we're at a $28 million market cap. What do you think about that, Shane? I mean, they beat their revenue forecast by over 20 million. Hell, their initial forecast, they beat that by 35 million. And the entire company is currently valued at 28 on the market. 16-cent share price. What do you think, man?
There are some things that are a little bit of an enigma. And it's like, that certainly has to be one. And some of it is like, I think a lot of people just don't get it. And then also, you know, there can be all kinds of gripes. Either way, when we run the numbers, it's a very fair assumption that the share price is undervalued. Now, everybody does their valuations a little bit differently. But, you know, I don't think you're entirely off to do like a 3 times price to sales. And what's that put it for this year? Like over $3 in fair value of what it should be? And of course, that sounds absurd with the market cap being 28 million and the share, you know, the share price being 16 cents. You know, people look at you like you're absolutely insane, but it's like, guys, I'm just doing the numbers. Like if I'm valuing it like you would value any publicly traded company, that's what it would come out to. And maybe you could debate 3 is aggressive, so you go down to times 2. And it's like, well, that's still over $2 a share.
Yeah.
And people just aren't getting this. It's like, I think if people learn how to do valuations and to look at this stuff, it would make it a little bit easier because then you can see obvious disconnects in the market. And that tells you, hey, I see a disconnect here. Let me go out. Let me pick this up. But again, it helps to be an investor because then you can deal with those up and down days. And when things just aren't where they should be, it kind of tells you, okay, my plan is just to continue adding and doing this.
Yeah, you nailed it there, Shane. You know, with the 3.0 price to sales ratio based on 2023's performance, fair value right now is $2.45. If you go with a 2.0 price to sales ratio, fair value based on last year's numbers is $1.63. Even the 2.0 in 2025 puts us at $3.09. I've been saying since 18 months ago, I said the target timeline is 2024, 2025. That's what I'm looking for. That's when the numbers made sense to me. That's when the valuations are there. And I've stuck with it. I'm still looking at this year and next year, one hell of a recovery. I think we're going to start seeing some better valuations. And like you said, you know, looking at the numbers, looking at the industry averages and just basing it on the numbers. That's what I do. That's why I love my charts. That's why I share them all the time because it's the OTC. You know, there's no institutional investors. There's no analysts giving price targets. We don't have any of that. We got it's all retail traders and day traders, and they're in it for the hype and the short runs, and the stock will do what the stock does. But I want to look at the numbers. I want to help educate some people, because we're talking about a company valued at $28 million that just did 140 in revenue, and there's no analysts explaining this to people. So that's where I'm at, man. That's why I share the charts and stuff, because there's no analysts doing it, and I do them because I track everything. I keep my spreadsheets, and next thing you know, I shared a chart or two, and people just loved it, and it was like, well, hell, it's all right there. I might as well just post them for people.
Yeah, absolutely wonderful. And that's the thing, is that helps illustrate kind of where things are, the numbers are. It makes it very easy to understand. And instead of reading through filings and kind of lining everything up, charts like that, they do make it a lot simpler. And that's the thing. I understand everybody has real jobs. So at the same time, it's difficult for most people to kind of commit all that time and kind of understand that stuff. You got a family, you got a bunch of stuff you got to take care of. So it's hard to kind of dig into those things and do it. So I think you do a wonderful job creating that stuff for people to make it a little bit easier to understand. So I don't think you get the appreciation that you deserve, because you do a wonderful job on those. So thank you.
Man, I appreciate that, Shane.
Yeah.
Well, hey, let me ask you a really important question, Shane. We're going to have to wrap this up. It's going to be too long. Let me ask you a question. Are you a financial advisor?
I am not a financial advisor. You should just assume that I am a complete moron. You can ask anybody. They'll tell you the same thing. Don't ever take any advice from me.
Yeah.
Do your own due diligence and research.
What about me, Shane? Am I a financial advisor?
I don't think you are either.
Nope, I am not.
Likes to make charts and graphs, and you're interested in the stock.
I do, and I enjoy coffee. You guys know that. I got a bit of a business background and stuff, but by no means do I have a degree in actual finance or advising. So my opinion is just that. Change is just that. We are not financial advisors, just sharing some personal opinions and some potentials and some graphs and what we're seeing for you guys to do your own DD and make up your own minds. Right, Shane?
That's right.
Hey, man, I appreciate the call, and hopefully we can do this again soon, brother.
Yeah, sounds great. Take it easy.
All right, later, man.